levered investing and building a passive stock portfolio. Normally on the channel, I talk about exchange traded funds or ETFs when I talk about passive stock investing because I like diversity. I like the set it and forget it approach. But I think I might have uncovered a better strategy using leverage at something like Interactive Brokers, where you can borrow at less than 1% cost of debt, 70% loan to value. So that means you can put in $1 and you can buy $3.34 of shares. And I'm going to talk about how you can do this tax efficiently, because one of my most popular videos for Canadian investors, those looking in Canada to build their own FIRE portfolio or their early retirement portfolios, everyone's talking about, how do I do it tax efficiently? Well, here in Canada, Canadian eligible dividends, and we'll talk about what a Canadian eligible dividend is, those eligible dividends qualify for a tax gross up credit, so that a person can collect about $52,000 a year per spouse. So if you're, two spouses in the household, that's $104,000 a year, completely tax-free, as in zero tax. Here in Canada, you get free healthcare, all the great benefits, and pay no tax, nothing. The reason for that is that the companies already pay some tax. So you get a credit for the tax the corporations have already paid. So let's say you buy Bank of Nova Scotia, CIBC, Enbridge, Pembina, any of the utility sector stuff like ALA and some of the gas stuff. Or there's lots of different companies in Canada. Rogers Sugar, as an example, that sells sugar to McDonald's. Lots of companies that pay between 5 and 7% dividend yield right now. And you can use leverage to get that way, way up. And then we can talk about using options to reduce your cost base and mitigate your risk against margin calls by buying puts so that you can't lose money. I'm talking about a high yield, good liquidity, no downside. There are some downsides, but I actually want you guys in this video, if you're watching the replay or you're watching it live right now, jump in the comments as I explain this strategy. It's a 4-part strategy. It's gonna take me about 5 minutes to explain it at a high level, and then we can talk about some of the nuances. But seriously, I've always subscribed to the idea that, and by the way, I went to finance school. You guys know I went to the Richard Ivey School of Business. I have a finance background. I come from, talking to a lot of people who are in the banking sector. And I know that 97% of hedge funds and actively managed mutual funds, et cetera, all those guys, net of fees, they don't beat the S&P 500 over a 30-year period. 97% of them don't, 3% do. So I'm thinking, how does this strategy beat the S&P 500? What am I missing? Why are hedge funds not exploiting this? Maybe they just haven't thought of it. I'm sure the quants out there have run this scenario. So I want to hear from you guys, what am I missing on this strategy? Is there something I haven't thought about here? What are some of the downside risks? But anyway, let's talk through it and have a constructive conversation, because I think this is probably, well, from a tax perspective, it's the best thing out there. There's nothing that comes close, because 100 grand a year tax-free is fantastic. The 17% ROI with no downside risk, again, we'll talk about that as well. I think it might be a little bit lower if you are, well, okay, we'll talk about some of the risk factors after, but let me explain the strategy. Let's get to it, guys. And then we'll talk about some of the downside risks, like interest rates rising is one of the only real risks for this strategy. But let's talk about some of the risks, and I think cost of options too will be another one. And again, this is not 100% passive. This strategy requires a little bit of management. I'm talking once you've set it up and you've bought you bought your portfolio and you've bought your options, you have to check in once a week, once a month, just to renew your contracts on the covered calls and the puts that you're buying. But let's talk about what we're going to do. So Canadian eligible dividends. What that means is you need to find companies that are eligible in Canada. So that means it excludes, foreign companies that are paying dividends on the S&P 500. It has to be Canadian companies. So you got to build a portfolio. You start with picking a portfolio. In my case, I have about 50 positions. So I pick 50 companies that I really like that all have solid blue chip type fundamentals, good cash flow, good consistent payment history of dividends. There's a couple screens you want to look at. That's one of the main ones. And then looking for a yield between 5 and 7% unlevered. So that means like companies like Enbridge that are paying like a 7% yield right now. If you just buy them, you put $100,000 in Enbridge, it'd pay you $7,000 a year in dividends. That's a good place to start. You want to build a portfolio around companies like that. You want diversity in sectors. So you want a little bit of, restaurants. You want a little bit of, manufacturing. You want to have a little bit of tech in there. Tech doesn't pay as good as far as dividend yield, but you have a little bit of tech in there, maybe 1%, and then you're gonna have a lot of utility type stuff like Bridge that are redistributors of gas. I like companies like that that are solid and consistent. Obviously, your financials, your bank stocks, your insurance stocks, those are fantastic, great yields and places to start. I do have a list that I can share if you guys are interested. You want to follow me on Instagram? I will share my favorite 60 Canadian dividend plays. A screen that I start with before I look at any of the, what's their free cash flow, what's their ability to pay dividends into the future, thinking about things like their past dividend history, how they fared in 2008, the last recessions, how they cut their dividend, is it consistent, et cetera, and so forth. Most of the blue chip stuff eliminates all that, but you still got to look, and you got to look through the screens and do your analysis on the companies. You want to make sure you want to own these companies long term, and you believe in them long term as viable businesses. You don't want to buy them just for the yield. So good businesses, solid yields that are going to last for a long time now. Okay, so a good place to start, dogs of the TSX, or dogs of the Dow is the strategy. Dogs of TSX pulls up all the best yielding companies based on price to dividend ratio. Dividend payment equals basically your yield, right? So you want to look for the highest yield and then cut out all the crappy companies that don't fit the bill. But anyway, so that's where you want to start. You pick those 50 or 60 companies, that's step one. And we can dive into the minutia of that in a second here. I want to go high level so you can understand the strategy, and then you can help me debunk it or figure out why it's so damn sexy and what am I missing. Okay, so I think it's the best portfolio you can build. It outperforms ETFs, it outperforms anything that I can find in the market, and it's super tax efficient and provides a ton of cash flow in retirement. So you pick these 50, 60 companies you love. Diversification is important. High dividend yield, very important. My portfolio, a little bit over 6% dividend yield unlevered. Then you go somewhere like Interactive Brokers. By the way, in the description, I will link. They don't pay me anything to link, but I have a referral code there. If you sign up, I think we both get shares in Interactive Brokers. We each get a couple of shares. So even if you want to just make a paper trading account, neither of us get anything, but it's a good place to practice and learn and understand basic options. Tastytrade.com is a fantastic place to go learn about options. They have some great stuff. And then if you want some Canadian specific content, you want to pay for a course, Irwin has the Stock Hacker program, which again, I have an affiliate link for, but I don't even know if it's active right now, so you can check that out or don't, whatever. But okay, so we'll go back to the high level of this strategy. One, find 50, 60 companies that you really like, that you want to own, that have solid dividend yield. You're building a nice Canadian eligible dividend yielding portfolio. Then you open an Interactive Brokers account. Well, okay, so first you open an Interactive Brokers account, then you find those companies you like. Then you just say, hey, I want to acquire these 60 positions. So where do you start? Instead of buying the shares, never buy the shares. It makes no sense. Don't buy the shares. Instead, sell puts. You go write the contract. Go write a put contract. You sell it. And you say, hey, you set a strike price you're comfortable with. You say, hey, let's say, we'll just pretend this company's trading at $100. The company you want to buy is at $100. You say, hey, I'll have the shares put into my account in 3 weeks' time for $95. And in return, you're going to get $2 or $3 premium for doing that. So you'll sell puts, and you'll basically be getting all those companies that you want, those 50, 60 companies, you'll be getting them at a discount. So that's the place to start, is sell puts till you get the shares you want. You want them to be put in your account. Now, if they don't get put in your account because the shares go up in value from the time you wrote the contract to the time it expires, in which case you would just take those money for nothing premiums. You just made a bunch of free money. They're going to pay you a couple bucks a share for free for writing that contract. You just write another contract until eventually you get assigned those shares. You want to eventually own the shares, so you go through selling those puts. You get the shares that you want. You've collected those shares at a discounted cost base. Next, once you have the shares, right, you've got the 50, 60 companies, you've got the shares in all those companies that you like, then you start selling covered calls on those companies at prices, whatever exit you're looking at, say 10% or 15% growth from now. That's capping your upside. So you don't want to go past that upside. You're saying, hey, I'm okay if the stock goes up 50%, I'm only gonna make 10 or 15% upside. In return, you get paid. Someone's gonna pay you for the right to be able to take your shares if the stock goes way up. So you're gonna collect premiums, it's gonna juice up your returns. Now I'm gonna pretend all that covered call premium isn't your money. Put that money aside. You're just here for the dividends. Take all that covered call premium you're using and then buy puts to protect against a margin call and protect against the downside. We were selling puts to acquire the shares. Now that we got the shares, you're gonna do buying puts covered. Covered means you own the shares already and you're collecting a premium for basically selling all of the calls, and you're using that premium to then buy the puts to protect against the downside. So I'm gonna rephrase this so people can understand. We'll dive into the minutia if people have questions they want to understand further. Basically, Let's pretend you had $1 million, just for easy math. You had $1 million, you put $1 million in an Interactive Brokers account. Take your $1 million, that can buy you 3.34 to 1 leverage. Or you could take the money out of Interactive Brokers. They'll give you a line of credit, automatic approval at less than 1% interest. This is where the strategy is sexy. The idea being here that you can take $1 million, you can buy $3.34 million in shares. So the math on that works something like, let's just go 3 to 1 instead of 3.34 to 1. We'll just reduce the leverage a little bit, leave you a little bit of room in your margin line in case, whatever happens, you have a little bit of room to play around and not get margin called. But so you take this $1 million, you put it in, you buy $3 million in, it'd probably be it'd be 3,334,000 in shares. But you take $1 million in, you buy $3 million in shares. Let's pretend for simple math, it's all in, all the companies are at $100 a share, just for easy math. You take $1 million, you put it in, you have $3 million in, let's call it a 6.5% yield, 7% yield for easy math. Just let me round up. Sorry guys, stay with me. So your $3 million is going to yield you $210,000 in dividend income. So your $1 million you invested buys you $3 million in shares. You've got $210,000 in dividend income, but you've got cost of debt on that borrowed money. $1 million of it's yours. $2 million of it is lent on margin at less than 1%. Interactive Brokers right now is lending on larger sums of money. Actually, you can go in there with $10,000 and they'll lend you at like 1.5%. But it gets cheaper and cheaper the more you put in. So I think with a few $1 million in there, I'm paying less than 0.5% interest, I think. It's like prime minus 1.5%, I think is what. Prime minus 1.6%. Prime minus 1.6% here, guys. So you can borrow super cheap. Like, I thought it was cheap to borrow against real estate. It's way cheaper to borrow against a stock portfolio than Interactive Brokers. Your mortgage on your stocks, your mortgage is way cheaper. So you can buy like a rental property, you can buy cash flow yielding businesses that are actually passive. You do nothing. You analyze the companies once, you have a nice diversified portfolio, you rebalance once a year, and it's completely passive, paid out quarterly. All the dividends will line up so that, a couple times a month you'll be getting dividend payments. It'd be consistent cash flow all the time. You'll be getting some money in from all these different companies. So your $1 million is getting you $210,000 a year in dividend income. Now you've borrowed $2 million of that at, let's call it a 1% cost of debt for easy numbers. So that's $20,000 a year in interest cost. So your $210,000 dividend, $20,000 in interest cost on the margin loan that you've borrowed against. So that's going to leave you $190,000 in net dividend income. Now, you've already bought those shares at a discount. So from day one, your $3 million in shares are probably costing you about 2.85 to acquire because you sold puts on them to get the shares. So you're already up 150 grand to start. So year one, you're gonna have 210,000 dividend income less $20,000 in interest cost, plus that's 190,000 net dividend income, cash flow paid out. Every few weeks you're gonna get a dividend payment coming out. So you're gonna have lots of cash flow. It's super liquid. You can close it out anytime you want. That's where you start, right? That's more attractive than anything I can find out there. Now, there's obviously risk with owning a stock portfolio, et cetera, and so forth. And we'll talk about how to mitigate that in steps 2, 3, and 4. So step 1, you've got the shares, you sold the puts, you're collecting a nice healthy dividend. It's amazing. It's in great Canadian companies, and it's tax freaking efficient. You're paying no tax. The first 100,000 you're earning, if you're a couple, is tax free. If you got some more in your tax free savings account, boom, there's even more. Tax free, you can probably crank out $10,000 a month in dividend income using your TFSA and the $104,000 that's tax free in Canada to live. So $10,000 a month tax free of it. The rest of it's at a preferred tax rate compared to interest bearing income or active income. It's much more tax preferred. And all of the capital gains on your stock portfolio, by the way, are only at half tax. Capital gains are only half tax free. So that's another advantage to it as well compared to interest bearing debt. So really great, love the dividend portfolio from a tax perspective. Now let's talk about, you've got already a great discount on your shares because you sold puts to get the shares. Now they've put the shares in your account. Now you own the shares, you're collecting healthy dividends, it's awesome. And you start selling covered calls. That means you own the share and you sell a call on that share. The idea of selling a call is this: you agree to have your shares called away in the future at a price above the current price. And in return, you get paid money for writing that insurance contract to someone, basically. So the way that works, if you had bought the shares, let's say using put contracts at 95, and now the shares are at 100. And by the way, I'll get to the comments in a second here. I just want to explain it, and then we can go into the minutia. Then you go sell covered calls, let's say at 110. So you're like, hey, if the share price gets up to 110, you can have my shares at 110. I'll lock in a guaranteed $14, $15 a share because I got them at 95. I'm okay to walk away from these shares at 110. You'd take your profits, you'd rebalance and put it into another, you'd find something else in your portfolio that you can buy that, would then yield some good money. So you take your appreciation, it's capped. Because you're selling covered calls, you're never going to go to the moon. This strategy limits your upside appreciation. You will not, if the market goes up 20% in a year, your covered calls are probably going to end up limiting your upside appreciation. But you're in it for the dividends. That's why you're here. You're trying to get that 17% dividend yield consistently every month, all the time. Now you take that covered call premium when you're getting covered. Most of the time, your shares aren't going to get called away because you're selling them far enough out of the money that most of the time you're just going to be writing these covered call options, collecting your dividends and your free covered call money, and then use the covered call money and all the money you got from using the puts as well as the money from selling the covered calls to then buy puts. This is really important. People will call this portfolio drag. They'll call this, hey, you're dragging down your overall yield by buying puts. Don't buy the puts. No, you have to buy the puts. The puts are your insurance. If we go through another COVID or another recession or something happens and your portfolio drops in value, guess what? You're gonna get a margin call. They're gonna call you and say, hey, your $3 million stock portfolio is only worth $2 million or $2.5 million now. Please put $500,000 into your account, or we're gonna start liquidating your positions until we can cover the debt to a $2.5 million 70% loan to value. So that's what's going to happen if you get through a margin call. So to protect yourself against forced sale, the worst case scenario is they force sale some of your shares at a price you didn't want. So you're going to have losses that you're going to get to write off at least against your portfolio. But whatever, that's the worst case scenario. To prevent against that, what we do is we buy puts. We buy them, a ways out. So, they're not gonna get triggered right away. Maybe instead of $100, we'll set them, if the shares are $100 right now, we might set it at, 85 or 90 and say, hey, that's an acceptable amount. When it gets below that threshold, I'm willing to activate those contracts. They'll be way in the money. You'll have tons, like in a recession type event where we have like a 40% drop, your puts are gonna save your portfolio. They're gonna ensure that you have no margin calls. You're gonna have a ton of cash to double down. Right? That's important to protect your portfolio. So you need to be buying the puts. That's the insurance on your portfolio to ensure that that 17% yield is consistent. Now, let's get into the questions in a second here. I want to hear the risk factors. The only thing I can think of, and I've spent some time thinking through this, would be maybe the premiums for the puts are too high. Maybe you're not making enough from the covered calls to cover it. So it might drag on your portfolio yield a little bit, but I can't see you getting less than a 15% annual return using this. And it's surprisingly liquid, surprisingly safe, all blue chip. Again, the only risk I can think of is rising interest rates would crush dividend yields and make your cost of debt higher, so your spread would be low. This strategy is banking on the fact that the government is so in debt right now. And you guys know my ethos or my, what's the word I want to use? My thesis in buying real estate the last 2 years has been the government has so much printed money and so much debt right now that it's going to balloon the prices of real estate and stocks, etc. I believe everything's going to be ballooned. We're going to go through a bit of inflation. The government's printed so much money, they can't afford for interest rates to creep back to 5, 6, 7%. The economy would be in shambles. We would have riots in the streets before we have 5% prime. That's what I believe. The government can't sustain it. So it won't happen. The Fed would rather have inflation than have rates get to that point. And their only way to stave off hyperinflation is to raise interest rates. They're going to keep forcing interest rates down. They're going to keep printing money. It just makes sense. The government wants inflation so they can tax all the capital gains on all of our assets that they've fakely appreciated in value. It's actually a great strategy. The government actually wants inflation. They won't call it out. They'll call CPI 2%. But in reality, guys, they actually want inflation. So that's good for all us investors, not so good for a tax perspective because they get to take more of our wealth. They didn't actually make any real wealth. They just inflated the value of our assets and they get to take a quarter of them. That's messed up in my opinion. Nope, Ariel, Daddy's on a stream. Can't come in right now, okay, sweetie? I didn't lock the door, guys, sorry. You can't come in right now, baby. Sorry, guys, I'm doing it upstairs because, again, I have a crypto miner rig and the power supply on it's super, super loud. So I figured I'd do it up here. But again, 3 kids, so it's chaos in my house right now. So, and now I'm going to go to the question and answer and see if I can dispel this, awesome investing strategy. I think it takes dividend investing to the next level. The leverage just really makes it super attractive. And people will ask me the questions in the comments. I'm sure you'll get like, hey, what about Quest Trade? What about, TD, Scotia, whatever, all the other brokerages? Their margin rates are terrible. So Interactive Brokers is lending up bankers' acceptance rates, like 0.5% interest, whereas Quest Trade's at 7% interest on their margin loans. So this stuff doesn't work unless you're at interactive brokers or a very low cost margin broker. So you have to switch over to interactive brokers. The advantages are far outweigh anything else. The way we make our money is the same way as in real estate. I can go borrow against at 2%. You guys know I talk about buying real estate with 2% cost of debt, 7 cap rate, and I live on the difference. This is the exact same thing, except no property management, no tenants, no risk. I can de-risk the whole thing using options and get a better overall yield than in real estate. So I like this more than I like buying real estate right now. Again, because I think that you can control the risk better. It's more liquid, better cash flow, just a number of reasons why I like this better. If you follow me on Instagram, by the way, guys, at Mike Rosehart, someone just asked about, what I'm doing with the little mining rig experiment. And it's just a little experiment. I'm just playing around. You can check out all my stories at Mike Rosehart on Instagram, where I've been sharing my journey there, and as well as my journey with options trading and et cetera and so forth. I always just share daily stories. And by the way, sorry about my hair, guys. It's just been, we have a week-old newborn, and life is crazy. I haven't had a shower in like 2 days, so I'm pretty nasty right now, I'll be honest. Hey, Anthony. Hey, number one app games. That's why I use ETFs. He says, yeah, so there are ETFs you could use, but I think this is probably a better strategy than the ETF strategy if you're willing to put in a little bit of time. Even a couple hours a week, once you spend the time to learn, it's very easy to maintain, and I think the yield is much better. But for those people just getting started, yeah, you can buy ETFs that lever for you. You can buy covered call ETFs. You can buy, there's nothing that really combines all of this into one. And I'm sure if there is a hedge fund, guys, that's doing this exact strategy, like focused on Canadian companies with high dividend yields, super diversified, that is using puts to acquire the shares and then selling covered calls and then buying puts. If they're doing that 5-element strategy, I want to know about that hedge fund. I want to have a chat with them. If anyone knows any hedge fund doing that, I'd be interested. If not, someone needs to do it, because it's freaking sweet. I would invest I just put my money in that. If someone built a hedge fund to do exactly what I want to do, that'd be even more passive. I would happily pay, 0.5% or 1% fee, or whatever the split is on the hedge fund. Some of them take 2%. I would happily pay that to not have to manage it myself. 2% is a little steep, I'll be honest. Some of the hedge funds do get pretty steep, like 2 and 20. There's some crazy structures some of the hedge funds charge to do this, which actually weights into your overall yield quite a bit. So something to think about when you're looking at the hedge fund approach, but it is more passive. Okay, I'm going to the question and answers now. I'm hoping there's some really good nuggets in there that can poke holes in this strategy that I kind of just made this on a piece of paper one night. I was just thinking through, I'm like, wait, how can I make this dividend strategy better? Wait, how could I've added leverage? Okay, how could I get the shares a little bit cheaper? Okay, I'll sell some puts. Okay, but then I'm like, oh no, what if I get margin called? That would ruin everything. It's high risk by borrowing all that money. What do I do? Okay, I gotta buy the puts. Okay, how am I gonna pay for buying the puts without dragging out my dividend yield? Okay, I can just sell covered calls on the positions I already own. Oh, cool. And then it's like, okay, I built a little strategy here. I can't find anything better out there. There are strangles and collars you can do, but I like this better because the cash flow is so consistent, and I want to own these companies anyway. It's just super, super tax efficient. Okay, going to the live Q&A. Let's go down. Do you have a PowerPoint or PDF for this? No. To be honest, I don't. You guys know I don't prepare for this. This is just like me winging it. Every week I lay down for 30 seconds before the stream, and I'm like, what am I going to talk about? What's new in Mike's world that I want to share with my audience, so I want to educate you guys on? And it's this. That's what I've been up to in the last couple of weeks, is building this out. So yeah, I don't have a PDF or ebook or anything on this. I probably should. I probably could sell the hell out of that. I could probably make an ebook on this with some like a nice tool to help you manage your portfolio. I could probably make $100 and just sell 1 million of them. It's just not my style. I should do it. It is my style, but I don't have the time. Again, I'm involved in 7 businesses right now. Got 3 kids, got a newborn baby, about to move. We got 1 million things going on, so I just the time to do it. That's the truth, honest truth. Congrats on the new baby. Thank you so much. Greetings to you, how to. Good to see you again. Thank you, Lauren. Next question. Thank you. Appreciate all the positive feedback, guys. I really do appreciate that. The birth of our third was a fantastic experience. The before the birth was traumatic, to say the least, but I got through it, just like I got through the other 2. And having basically 4 kids, my puppy, my dog, I consider a kid as well. So I'm actively drained in all directions. Even my dad was staying with us. He's going through a divorce, and so he was staying with us. And I've got in-laws in here, and my house is a full house. I actively am supporting a lot of people in my family, and that's why I did this. So I built all this wealth, and why I've grinded so hard is so I can help support my dad and help support my mom, and be there for our in-laws, etc., so forth. So I'm not complaining by any means. I'm actually happy to, my dad was living with us for a bit, and it was great actually. I hadn't spent a lot of time with my dad in a long time. And so it was great to be able to reconnect with him. And so I'm glad and fortunate to be able to provide that for my family. So anyway, I am very, very busy. And that's why if you ask me to do something like create an ebook, it's going to be like next year at the best case, probably. I make enough from other sources that I don't really need the money, right? It's like I'm trying to sell a course or anything right now. Although I am partnered with guys, Rosehart Enterprises coming soon with courses and books. I'm investing heavily in that, $5,000 a month right now into that. So it is coming. And I do believe there's a huge value in the, I guess, financial education space. And I wanted to be in that space. So I will be investing heavily in that space and using my brand as well as my money to help invest in that area. Education is important. But yeah, I don't have the time to build those out the way that I would like. Okay, next question. What do you think about buying, someone just typed and it moved, buying VDIGX instead of individual stocks? I don't follow that. I have to look up the acronym. It must be some sort of ETF that buys a little bit of everything, it sounds like. I was a boglehead. I like Vanguard's approach to building passive exchange-traded funds that basically can mimic the entire market, super diversified, super passive. I just don't think it provides the cash flow that I need and want, as well as the upside. And to be honest, I'm having too much fun with the options trading, kind of on the positions I want to hold anyway. So I'm trading options on stuff that I want to own anyway, that's solid. And so the worst case scenario is if my options trade goes bad, I own shares that I wanted to own anyway, or I end up acquiring a position, maybe at a cost I didn't want, but at the time that I wrote the contracts, it was a cost that I wanted on those shares. So I don't feel too bad about it at the end of the day, and I've been having a lot of fun with it. If you check out my Instagram stories, you'll see today was a great day. I made $36,000 today trading options. So if I could have days like today, even 20 days a year of the, all the days in the year, if I could have 20 days like that, there's like 800 grand a year just in options. So it's very easy to get into 7-figure years, especially as you build some real wealth doing this. Yeah. Have you ever tried a back ratio put to get into a position? I don't know what back ratio put is. To be honest, I'm not an expert in options trading, just getting into it again. I took some courses on it in school, and that was like 7 years ago. So like I understand, putting a call or whatever, but I have not taken any of the advanced stuff. I don't know what a back ratio put is. Maybe I should know what that is. Maybe if you explained it, I'd understand it, but that acronym is lost on me. But yeah, maybe I am using that strategy. I don't even know. What's the difference between those two Vanguard? I don't know. I'm not sure which two you're talking about. How far out till expiry usually? So it depends. If I'm buying a company and I know there's a certain earnings date or a certain, ex-dividend date or whatever, those dates play, like I should be looking at those dates when I'm buying a position because it's important, on a dividend date. If you end up getting assigned the shares, it may get assigned just before the ex-dividend date, in which case you get a whole quarter's dividends paid out to you, which is a nice sweetener on those shares you just got assigned. So that's pretty sweet on the dividend stuff. And you definitely want to be watching that when you're selling the puts. So you can collect, let's say it's a 7% yield for the year and they pay that out quarterly. If you get assigned right before the ex-dividend date, you may end up with like a 2% discount on the stock, even if it's down, right? But then that also plays in because people are factoring in when they're trading on the shares of the price, they're factoring in that they're going to get that dividend. So typically the shares rise right before that anyway, but I don't know, whatever. More than likely you wouldn't even have the shares put in your account, but whatever. There's a lot of factors to think about when you are placing your contracts. And I'm by no means perfect, but yes, that is one of the things that I would look for sure when I'm placing that contract. With the wide spreads on selling calls in Canadian stocks, does the sold call generally still cover the cost purchasing the out of the money put after fees? It's a good question, Anthony. I haven't tested it fully on every stock, only on a few. but that would be something I'd want to test out and find. The hope is that it doesn't drag on your yield too much. But even if it did, I'd put it aside. Let's say forget all the, okay, so all the fees on the, or all the options premium you've collected on selling those puts to acquire those shares, put that aside to buy the puts, and then the covered calls, hopefully, if you're selling enough of them, it makes sense, right? So, yeah. Aiden. Hey, how you doing, Aiden? Hello from Canada all the way to Australia. Good to see you on, man. I hope things are well and good with you. Okay, going up here. Where was the question we were on? Oh, I found it. So Anthony's question was about buying those, selling Canadian stocks that sold call generally still cover the cost to purchase the out of the money put. Right, so the out of the money puts that you're buying, those are your insurance in your portfolio, right? That de-risks all of the leverage that you're, all the debt you've taken on. The risk in the debt is that if it falls, you can't, because let's think about this. The first risk is like, can you make the interest payments on all that money you've borrowed? But because you're buying dividend plays that are levered with tons of positive cash flow, servicing the debt, non-issue. It's like buying cash flow in real estate, but actually way better cash flow. And when we talk about the risk and leverage in real estate, if real estate falls in value, the bank could call you and call your mortgage. Now, they usually don't because real estate tends to rise and the bank typically doesn't call on mortgages. In 2008, they did do some of that. There was some stuff where like, hey, you had a $100,000 property, it's worth $20,000 now. We're calling you on your $80,000 mortgage. So there was some of that and people just walked away, and that's why the whole housing issue collapsed. So it is always possible in real estate you could be called. In the stock world, calls, they just start liquidating. So it's different than in real estate. They can't just liquidate your property. There's a whole process to liquidating a property. So it takes a lot longer for a mortgage call on the real estate side than on the stock side. So levering for stocks is inherently riskier. There's no doubt. So you have to buy the puts to protect yourself. That's essential. We know long-term, all these dividend companies do this. They go straight up the same as real estate. So 10 years from now, all these companies would be a fantastic buy right now. That's just what we know. And the dividend yield every year is going to make up, even if it was flat for 10 years, all those dividends would be insanely positive, right? You'd be like 17% yield. Your money's growing and doubling every, rule of 72? So every 4 years, your money's doubled basically if you compound it on itself. So with this strategy, even if you're flat and there's zero appreciation on the stocks and they stay the same as they were, and let's say you give away all your appreciation just to buy the puts. Also check out the book Black Swan if someone's interested in reading about that. Black Swan events talk about buying puts that are out of the money. They actually have a good ROI. You'll lose money for a while until we hit a Black Swan event where the market crashes and you get a huge payout because you're levered and you're protected. So that's where I think buying the puts makes really good sense. In the short term, it might feel like you're paying insurance every month or whatever to protect your portfolio, but at the same time, and protect you against margin calls. But it's essential. That's what makes the portfolio so attractive. If it was a 17% yield, but the market could drop at any time, that's risky, right? Like it's like buying Tesla stock. It could drop any time. Or GameStop. It's not like buying those because GameStop is based on no fundamentals, and I'm buying blue chip shit that's solid, has 50 years of collecting it. Like Enbridge as an example is one of my positions, like 3% of my portfolio, and a very small percentage, but still, that's actually one of my largest positions. And Enbridge is a great example, or like Rogers or whatever, like lots of these companies that have been around for 50, 60, 70 years of paying dividends consistently. We all have our cell phone, we pay our bill every month. That's not going anywhere in a recession. Or like our gas bill. These guys they just deliver the gas to the house. They maintain the lines. So they get like a $100 a month infrastructure charge from every single house, no matter what. Recession or not, they're charging that bill. They don't care what the price of gas does, doesn't matter. They're collecting an infrastructure delivery charge. Companies like that, like how do you go wrong owning something like that? In a recession, whatever, we all still need to heat our houses. Like here in Canada, I feel like that's a solid play. And because of that, I feel like the risk is very low already, but I'm still going to buy puts on it. Because I want to protect myself against those market fluctuations. And yes, it will drag on the portfolio yield. Hopefully, selling the puts in the start to acquire the shares and selling the covered calls covers almost all the premium. It depends, again, how much you want to insure, right? Like, you're going to buy a put out of the money at 20%? Like, are you willing to take a 20% drop? Or are you going to buy it at 5%, right? Or 3%? And the closer you get, the more expensive the premium is going to be, right? And so you got to factor in how much and how far out are you going to buy too. Like ideally you're buying them very short term and you keep buying them because they're cheaper that way, right? And ideally you also trade them too. So on days where it's crazy up, you might sell off, days where it's crazy down, you might sell off the puts you bought. And then the next day when it's up, you might buy again, right? So you could trade them a little bit too to reduce your cost base on that insurance. But the buying the puts piece, it only drags in your portfolio. It is insurance. It's going to take away from your yield, but it's going to protect you. So instead of getting 20% a year yield, maybe you'll end up with like 16%, right, or whatever. But that's still a super healthy yield, paid out, very frequently. You're collecting cash every few weeks. Someone's paying you a dividend from one of the 50 positions in your portfolio. So it's, I think, a really good retirement strategy. You can take $1 million and collect, 150 grand a year, super conservatively, de-risked in tax-free. Let's say a worst case scenario, your $1 million gets you a 12% yield. That's $120,000 a year. Let's say you got $210,000 in dividends and you spent $20,000 for cost of debt. You're at $190,000. Let's say you spend another $70,000 on just buying the puts, and you take all the premiums from selling the covered calls towards those puts too. And probably more likely than not, eventually we're gonna have a downturn or a down day or a quick reset, and those puts that you bought are gonna pay off huge. And they often pay for themselves. Like the last 6 months you buy insurance, it pays for itself. In this case, it's really a smart thing to do. Most people are betting the market's gonna do this because long-term the market does do that. It goes straight up, guys. And so buying insurance on something that's appreciating in value is typically fairly cheap. Whereas if you're buying insurance on a car that's depreciating, right? It's a different set of circumstances. So the insurance should be cheap. Again, there's just so much that, just so much out there to think about, right? And someone just made a comment. I think people don't realize that 10+% is insane considering most traders don't even beat the market. This is true. Over a 20-year period, almost no traders beat the S&P 500 index, which should be their comparable. That's something to think about, right? This strategy is actually insanely powerful, especially the fact that you can de-risk and that it's so consistent. The dividends keep coming in month after month. If your portfolio drops in value, those dividends keep coming in. Most of the time, the dividend yield rises as the share price falls. The only risk that I can think of, and I could be wrong, maybe there's something I haven't thought of, my only, worst case scenario, you're looking at a tax-free $10,000 a month on every million, or I guess on the first million anyway. So you get $1 million you put in Interactive Brokers, buy $3 million in shares using the leverage. Let's say you even had to spend, instead of getting a 17% yield, you took an extra 5% of that dividend yield and you put it towards extra puts. Like you just wanted to protect against any drop at all. I think, yeah, I don't know. Let's go through some of the questions here and let's think through things. By the way, thank you for the super chat. It's good to connect with you. I hope you're doing well. Super chats are awesome. They support the channel and they keep the internet on. I actually bought a separate internet just for this. So I pay $60 a month, but that's because I'm in an abundance mindset now. It's not that I'm in an abundance mindset necessarily. It's that I now realize that my time is so valuable and I earn so much per hour that $20 isn't even worth a second of my thought because I'm earning so much from so many sources now that if you earn more than 7 figures a year, like if you're in the 7-figure annual income club, expenses stop, like within reason, expenses stop mattering. Like $10 at Starbucks or whatever, it doesn't matter. It did matter getting from where I was to where I am now. Like the frugality piece is how I built my foundation. It's super important. But I'm on the 10th floor now. And I don't need to worry about how I built the foundation. I need to worry about how I'm gonna get to the 20th floor. So it's just a different mindset and I have to focus on how I use my time as effectively as possible. Sorry, I diverged off the topic again. We'll go back to the topic of this specific trading idea. Maybe some people have back tested the costs and I'd like to hear about it. I'm just experimenting with it now and I don't have any data. I'm not a quant. So if someone has that data, that'd be cool. Okay, so Gloria says, any idea why Interactive Brokers is so cheap percentage-wise compared to the other brokerages such as TD or Schwab? This is a great question, Gloria. My understanding is that I think the lion's share of Interactive Brokers is owned by one dude or one person, and that person, I think that they use the margin as a loss leader to attract traders. They charge the traders on the fees. So when you do a trade, they charge you. When you do, you buy the data from them, they charge you, et cetera and so forth. They make their money in the trading as opposed to making on the margin. And that's so smart and so attractive because they're attracting all of the wealth. Like guys like me who have millions, I'm never going to go to Questrade. Questrade's lost that business. They can't compete at 7%. They charge 7%. They have Questrade has a nicer platform. They're more intuitive. Interactive Brokerage charges I think if your account's inactive, they charge you a fee. There's a monthly fee if you don't trade. There's a bunch of stuff that Interactive Brokers makes their money on their fees. So I think that, in my opinion, I think they make all their money on their trading fees. They don't make it on their margin, but just so cheap. Like they're literally lending at banker's acceptance rate with no fees or like very minimal fee. So it's just, I don't know. They auto approve everyone. Put $100,000 in the account, you get a 70% loan to value line of credit right now. Like literally, if you have $1 million in shares at Questrade and you port them over to Interactive Brokers, you bring the shares in kind over to Interactive Brokers, and they're all blue chip stuff. Like they only lend 70% loan to value on blue chip stuff. So if you're buying penny stocks and garbage, they're not going to lend against that. But solid, good stuff on the S&P 500. They got a list of approved, companies. Most of the good companies are on there. Stuff you actually want to own are on there. So I do think that it's important that you understand you have to invest in quality stuff. But if you move those shares over right now, they'll give you a line of credit right now, 70% loan to value. You move $1 million in shares over, they'll give you $700,000. You can pull it out and buy real estate if you want. Leave your shares in Interactive Brokers. That's broken, in my opinion. Like, why is everyone not at Interactive Brokers right now borrowing at 0.5% interest point? Prime minus 1.5. I'm almost, if it wasn't for tax, all the tax complications of selling my entire real estate portfolio, I'm almost convinced to sell some of my real estate off, like a good portion of it, and move it over somewhere like Interactive Brokers where I can lever it way cheaper than real estate and get better returns overall. So I don't know. Again, just so easy and so simple. It's got a great app. My phone, I'm streaming from my phone, but I'd show you guys the app. Super easy to use. Anyway, so next question. That was a good one, Gloria, because it does seem too good to be true that they're lending at. Hello. Says I'm live, but the timer's not moving. Says I'm live, but the timer's not moving. Can you guys see me? Hello? Hello? Someone tell me we're live or not. My IT guy who's coming to look at one of my crypto rigs just called me like 3 times. He's like, yo, can I come to your house and check on the rig? And I'm like, I'm live. This is why I need 2 phones. Ugh. Okay, I'm back. Good. Good. Sorry. We back. We good. I'm gonna wrap this up soon anyway. I gotta get through these questions and meet my IT guy to go look at my rig. One of my rigs is having a little issue, and we're just gonna tweak it to get a better hash rate. It's just not, the cards aren't hashing what they should, so I gotta play with the overclocking settings. And anyway, it's a cool little project. Mining a few Ethereum a month, just as a couple of Ethereum a month. Just as a practice. Me and my mentee are doing it together and just JVing it. It's just a little beta test. Who knows? Might end up selling the equipment, or equipment might break. Anything could happen. It's high risk, but I'm having fun with it. Okay, back to the questions here. VYM is open market. You can buy from a regular account versus VDIGX. Again, I don't follow these acronyms, so I don't know. I'd have to look up the acronym and see what ETF it is and what it holds in its portfolio. I can buy that, I think, or swim instead of having a Vanguard account. Correct, Jack. Okay, so someone's jumped in here and they're helping out, which is great. Thank you, number 1 App Games. Brock says, hope you're doing well, Mike. I like how you're sharing your new interest in stocks. I think it is important for people to know that more risky stocks doesn't allow that much margin. Very true, Brock. And I mentioned that just a second ago here that, again, you have to be buying stuff that's solid and blue chip. But why would you buy the super risky stuff when you can buy the solid stuff and collect such great returns using leverage? Again, you could buy puts that are maybe like, when you're buying your puts, it could be like 30% losses, and then it's a lot cheaper. So the more you want to insure yourself, the more expensive it is for that insurance on that position. But you could, if you're really bullish on the market, you could just forget the puts altogether, and you could just collect a sweet dividend yield, get all that appreciation on the stock portfolio, and collect a juicy premium for selling those covered calls. So you could really get like a 30 or 40 or 50% return if you wanted to without any of the puts. The puts just give you that insurance so you can't lose. And to me, 16% with no loss or very little loss, like say a 5% loss, is way better than making 40% with the risk of losing. So that's just me. You guys know when I invest in real estate or businesses or whatever I'm doing, I manage the hell out of risk. That's how I'm gonna get to $1 billion, is that compounded annual growth, very low risk, consistently moving in the right direction. Warren Buffett has said, many other investors have said, it takes twice the gain to make up for a loss. If you have $100 and you lose 50%, what do you have? You have $50. Now, to get back to where you were before, you need 100% gain. So if a stock goes down 50% and goes up 50%, you have $75. You start with 100, it goes down 50%, you have 50, it goes up 50%, you have $75. Losses take twice the gains to come back. That's why I don't like losses. That's why I'm so loss aversion focused. It's also because I grew up with nothing. So growing up in poverty, it sucks. Having no money, it sucks. I don't want to go back to where I came from. Came from nothing. I want to make sure that I maintain my wealth. So I'm very, very focused on capital preservation as my number one. Again, I need to have a good enough return for it to make sense. Like, I'm not buying treasury bills at 1%. In my opinion, that's just not worth it. So, you guys hear me? It says we're live. Am I live? I don't know anymore. I might switch over to the other internet if I'm not live right now, guys. Someone tell me we're live. You guys are tripping me up. Yes, okay, cool. We're live, okay, good. Someone was tripping me up when I saw that stuff. I'm like, are we actually live? Paul Plumstead. What a wholesome dude, man. I like Paul Plumstead. He's a wholesome dude. Says, thanks, Mike. Got the gears turning on strategies. Could you step through a put strike price on Enbridge and a covered call example with current price around 45.78? Yeah, so I could walk you through what you might do. So let's say you had a down day and you wanted to acquire the shares. You could go in your options wheel, and you basically see different strike prices and different dates. So you could slide across to like every Friday. There'll be like the weeklies. So like there'll be this Friday, April 1st. There'll be April 8th, whatever, 16th, 24th, whatever. You click the day you want to go. So you can go monthly too. So you go a long ways out. You go a short ways out. The further out you go when you're selling a put, the more you're going to get paid, because you're guaranteeing to take the shares at a set price. So let's say I say I'll take the shares at $39. You're like, I would love to own the shares at $39. That's a great price to own the shares. I like the company, I like the fundamentals. I would love to own it at $39. You go and you say, in the next 2 months, I'll guarantee I'll have those shares put in my account at $39. So you go and you pick a date. Let's say it's 2 months from now, and you go to $39. And because $39 is pretty far from the current price, it's probably not going to be paying that much, but you're going to get paid something for doing that. And it might be, let's just call it $1. And I don't know what it would be, but let's say it's $1 they're paying. You click the $1, you go click sell, and then you would sell that put option. You could buy the number of contracts you want. Each contract is 100 shares. So if you did one put contract, you would get 100 shares of Enbridge put. If the price of the shares goes below 39 or below, actually below 39, and if you're paying $1, you actually don't lose any money until the shares are at 38. So let's say the shares fall to 39 or like 38.50, and they get put in your account at 39, right? You got paid $1 premium to sell that contract. So your cost base is really still 38, which is awesome. More likely than not, what's going to happen is the shares are going to be flat, or they're not going to hit that low point because you're pretty far out of the money. Now, if you really want these shares, you go closer to the current price. Like you might go, a month from now at $1 less than the current trading price. And if you really wanted the shares, right? If you want them to get put in your account. If you don't, and you want the probability of them not being put into your account, then you want to make sure you're further out, right? So you'll take, in that option, let's say it was $1 a share, you bought one contract, so they pay you $100 to sell that contract. So if the shares get below $39, they put them in your account, and you make $1 a share no matter what. So your cost base would be $38. If the share's above $39, you just make $100 for nothing. So if you did 10 contracts, then you make $1,000 for nothing. If you did, 100 contracts, et cetera, so forth, you'd make, it can be very good premiums to discounts to acquire the shares that you want by collecting those premiums. So yeah, I think I kind of walked through that at a very, very basic level, but how long an option expiration date are you using on covered calls? One with expiration date or closer to 6 months? It just depends. It depends on what it's paying. It depends on so many factors. Each company would be a little bit different. There'd be different dates you'd want to maybe trade against, and a whole bunch of things that come into play when you're picking. When you're going to sell your covered calls, you could do them very frequently and then keep reselling them. You could do them longer out. Lots of ways to do it. I haven't studied the differences between doing a bunch of short ones or doing a bunch of longer ones. It depends on the stock too, and you want to look for earnings dates and all these kinds of things when you're deciding the dates as well. So there's lots that goes into that, and I haven't thought it all through, but maybe someone can link in the description and let me know, or in the comments after this video, let me know. Woot woot, made it to the live show. Awesome, JP. Congrats on the new baby. Thank you. Does this strategy still apply if you have a full-time income, i.e. the tax savings, or is it only efficient for retirees? Jordan, it's less efficient if you have other income. So it becomes less and less efficient as you have more and more income. So the dividend strategy is most efficient in retirement or if you have lower income. Yeah. You can use leverage. What's the cost of interest? Yes, you definitely have to use leverage. That's the cornerstone of this strategy, and the cost of debt is less than 1%. So it's prime minus 1.6 approximately, or a little bit less than that even, depending on how much you invest. If you start with a little bit of money, it's like 1.5% interest, and then it scales down to 0.5% interest the more you borrow. But thinking about an ex-dividend date investment strategy with options, yeah, there's definitely something you can do with that. There's lots of cool stuff you can do with that to juice up your returns and get some really good dividends. How high have your expenses gone up with 3 kids now? Not a whole lot, a little bit. Heard about your levered approach to investing in Matt's podcast. Great job, Mike. Keep it up. Thanks, appreciate it. Butch says, would this strategy be still applicable while living in the US, or would the tax be an issue here? No, like US has its own tax incentives. I don't know the tax code in the US, but this would definitely work in the US too. And the strategy still works, even if there isn't the tax advantage of this. It's still a nice, sexy strategy where you get great cash flow. Back sell 1 put out of the money, buy 2 puts further out of the money for a credit. Yeah, there's an idea. I gotta go, guys. My kids are screaming in the background. Evening, Mike. William says, I think the challenge is long dated puts at the money using Enbridge. Cost close to 7%, even after selling cost 10% higher than the current price. Yeah, so you may want to do short ones very often and use the calls to cover the cost. Do you think it's worth it to refinance the property that uses a small portion of the proceeds to purchase a few crypto rigs, assuming Bitcoin price stays, or is the cash on cash better in real estate? I think that the risk is much higher buying crypto rigs than in real estate, but the returns are way better. Like if you're not doubling your money using crypto rigs, like you're getting all your money back plus, then I think you're doing it wrong in the crypto side. Elemental says, I think people don't realize that 10% plus is in the same return. Yes. How far to the money do you buy your puts? Again, it depends. I think that the further out you go, the cheaper it's going to be on the insurance, right? So you can tolerate, buying them at 80 on the $100 share price. Then you take that risk of that loss, but you cap your losses. So you choose how much loss you're willing to stomach, and then also how far out you go. The further out you go, the more expensive it is. So I think it's cheaper to keep buying them, every couple of weeks. It's more work, but it's a lot cheaper. So it depends how active you want to be. Yeah. Hey, Mike, great content. And by the way, you can also trade them too, right? So on the down days, you can get rid of those positions for huge profits. So the put might not cost you anything. You might be able to just trade the covered calls you're selling and the covered puts that you're selling covered puts that you're buying, because on the days where it's up and down, you could trade that and use that to offset the cost. So it might not cost you anything if you're smart with it. Hey, Mike, great content. Which high-yielding dividend stocks would you prefer for new investment? Arjun, you can follow me on Instagram where I share a lot of the positions I like on there. Carla says, folks who ask for a PDF on it probably don't have the knowledge of options to understand your strategy. This might be true, but they could also learn, and then they could watch the video again and again and again, and eventually they'd be able to figure it out, I think. So hopefully people can figure it out. Michael says, how are you borrowing $3 million with $1 million interactive brokers? I thought they just margin 60%. Michael, they margin 70%. But what that means is, so let's say you take $1 million and you borrow 70%, you have 1.7 million in shares you can buy. They'll give you 70% of 1.7 million. So effectively just keep borrowing against itself. As you borrow more, they'll let you borrow on top of that. And so how that works out is $1 million buys you $3.34 million in shares. Does that make sense? You can keep doubling down on that money you've borrowed. So you borrow 700,000, then they'll lend you 490,000 more. So there's just 70% of 700,000 and 70% of 490,000, et cetera, and so forth. If you just follow the logic on it, it ends up, you can basically go 3.34 to 1. Have you ever considered becoming a Lloyd's of London name? Reading about it today. I have no idea what that even is. Should I know what that is? Someone messaged me what that is on Instagram. Tasty trade, guys don't recommend selling options beyond 45 days till expiry. Yeah, that's been something I've heard as well. The further out you go, the more expensive that IV is, and you want to keep that as low as possible. So I like to, again, keep it pretty close. Thomas says, hey, what type of jobs would you suggest for someone trying to make money to invest? Would small businesses in specific fields be most effective? Thomas, it just depends on what your interests are and your skills. There's so many factors. I can't tell you what you want to do to make the most amount of money. Chase your passions and your skills and find where they intersect. That's probably the place you're gonna make the most money. Hey Mike, I'm a first-time investor. Which different stocks would you recommend? Follow me on Instagram and I'll share a lot of the picks. Cool. Okay, I think I got through all these. Oh, I gotta go. Thanks for sharing. Have a great night. What do you think about straight covered calls on bank stocks in a TFSA? You could. Again, there's only so much you can do inside of a TFSA. You're limited on what kind of option stuff you can do. And there's always the risk that they come back and say, hey, you were speculating, and they take away that tax-free incentive. Like people with GameStop are losing the tax-free incentive of the TFSA because they say you're speculating for profit as opposed to investing. So that's something to think about too. But yeah, I mean, you could. Of course, you can control more shares using calls to juice up your return, for sure. All right, everyone. Thank you so much for watching. It's been a great hour. I really enjoyed giving back tonight and all you guys sharing your thoughts with me. I look forward to seeing you in the comments on this video. Smash that like button, please. If it meant something to you and you got some value from this, hit the like button. And then on Instagram, if you can share it, like share it on Facebook, share it on anywhere so someone else watches this video, that'd be cool. Share it in a FI group, share it somewhere. I'd like to find someone that's watching this that understands the nuances of options trading, can help me tweak the strategy to make it better. What am I missing? What am I not seeing? Because I'd rather know now than know later, a year from now, and I'm like, oh, I didn't see that angle, and I just lost like $1 million. So I'd like to know what I'm not seeing. Help me to see what I'm not seeing. Help me to see the downsides. I don't see interest rates rising, so I don't see that as a downside. So find me a real downside that actually detracts. I guess if we went through hyperinflation, I'd be limiting my upsides. That's something. But if anyone knows, share. Let's get into conversation on Instagram at Mike Rosehart. In the comments here, Facebook, whatever. You guys know where to find me. Anyway, the secret to unlocking a wealthier you, 3 steps. Spend less, earn more, and maximize returns on the difference. That's how you build wealth. I'm focused mostly on maximize returns on the difference because the returns are so important to me now that I've built a huge amount of wealth. But for you guys just starting out, it's all about reducing the spending and finding ways to earn more money. It's not so much about the returns until you've built up a sizable portfolio, at least 100 grand for it to even matter what you're investing in. Just start investing in something. Start compounding. Focus on the saving. Focus on the earning of the income. Thank you all so much for watching, and I'll see you next week live for the Mike Rosehart Show. And I'm always here in the comments and on Instagram, so look me up. Bye, everyone. Happy Wednesday.